In this video, we're going to go over what happens to the three financial statements when you issue new shares and then when you repurchase shares that are already outstanding. So our approach here will be to first go over what exactly I mean by issuing and repurchasing shares and some basic definitions. Then we'll go into why a company might want to do one of these two scenarios. And then we'll finally go into a few examples of how you actually translate this in accounting terms to the three financial statements, and then how you make sure that the changes are properly flowing through the statements. So to start with, what I'm referring to with shares outstanding is just this number that you see at the bottom of the income statement right here, under net income and under earnings per share. So when a company is public, it has shares outstanding. This represents ownership in the company at a very basic level. So in this case, these units are in thousands, so this 100,000 represents 100 million shares outstanding. So what this means is that if you buy a share of a company, you now own 1/100 millionth of the company. If a company has 10,000 shares outstanding, you buy one share, you own 1/10,000th of the company. So when you log into your E-Trade or Ameritrade account or any other personal trading account, and you see that the stock price of this company is $10 per share, they have 100 million shares outstanding, so you can go in and buy shares of this company for $10, and then each share you buy will give you an ownership interest of 1/100 millionth in the company. It may not seem like a lot, but keep in mind that most of the time it's large institutions that will own millions and millions of shares here, so it adds up, and with most companies it's really large institutions that own the bulk of the shares. This par value of stock right here, this is just a paper value that has nothing to do with the current share price. When a company issues new shares, they have to record some value for it for accounting purposes on their balance sheet, and this is what the par value represents. In a lot of cases, the par value of the stock is actually more like 1 cent or a tenth of a cent or 1/100th of a cent, something very, very low. In this case, I've just kept it to $1 to make some of our math easier and to keep the numbers a bit cleaner here, but the par value is basically just the paper value, and you do have to take it into account with some of the interview questions, but really most of the time you're focused on the current share price based on what's happening in the market, what the company is trading at in the market instead. So those are the basic definitions. Now to get into why a company might actually want to issue new shares. There are many reasons for this, but basically a company would issue shares when they need cash. They need cash, so that means they need money for acquisitions, for repaying investors, for repaying debt, for buying factories, expanding. So anything like that. Any of these could be valid reasons why a company would want to issue new shares. And keep in mind what's going to happen here is that when they issue new shares, they're going to be selling them, and so their cash is going to be going up. They get the cash and then they use it for one of these purposes. Why would a company want to repurchase its shares outstanding that are already out there in the market? Probably the most common reason is that they have an excess cash balance and they don't know what to do with it. They want to reduce some of their cash and repurchase some of their shares. Now, a side effect of reducing the shares outstanding will be that the EPS, the earnings per share, will also go up. So this could be another motivation for them doing it. And then finally, a company might repurchase some of its own shares if it believes its stock price is going to rise over time. So if it believes the stock price is going up from $10 to $20, it may repurchase some of its own shares so it can reap the full benefits of this happening. So that's the motivation for a company issuing and repurchasing shares. Now to go into an example of how you do this, I'm going to go over here to the interview questions. I'm going to say 100 for issue new shares changes by. Let's start with the income statement. There are actually no changes to the income statement down to net income. All that changes here, and you don't even need to mention this in an interview, is that shares outstanding goes up by 10 million here. How do we know that it goes up by 10 million? Because we've issued 100 million worth of shares and the share price is $10 per share. 100 million divided by 10 equals 10 million. So that's how we know that we're issuing 10 million worth of shares outstanding here. Over on the cash flow statement, issuing or repurchasing shares does not show up as operational or investing activity. So we go to financing activities. Issuing new shares gives us 100 million worth of additional cash here. So our cash flow from financing goes up by 100 and our cash balance here goes up by 100 as well. On the balance sheet, cash goes up by 100. No other changes, so total assets here are up by 100. On the other side, no changes to liabilities. Under shareholders' equity here goes up by 100 to reflect the fact that 100 million worth of new shares have been issued. And then our balance sheet balances because assets equals total liabilities plus shareholders' equity. Both sides have gone up by 100. Now, in an interview, you're usually fine saying something like that, but if you want to get more technical and more precise, what actually happens here is that common stock goes up by $10 million, and then additional paid-in capital goes up by $90 million. And the reason for this, the reason why this happens, is that remember what I said before about the par value of the stock. This is what has to be recorded on a company's books, and then the current share price is what it's actually worth in the market. So when you issue additional shares, what actually happens is that for common stock, it goes up by the number of new shares times the par value. In this case, we know that we have 10 million worth of new shares. So common stock here goes up by 10 million times the $1 par value. Additional paid-in capital, or APIC, by contrast, goes up by the number of new shares times the share price minus the par value. So basically the excess of the share price over the par value of the stock. So that's why we have 10 million new shares here. We have a share price of $10 and we have a par value of 1. So APIC here is going to go up by 10 million times 9, or 90 million, which is the number that you see right here. So that's a more technically precise treatment of new shares here. But again, in interviews most of the time you can just get away with saying that shareholders' equity goes up by 100. Now to look at the flip side scenario here, which is what happens when you repurchase shares. So in this case, I'm going to enter 100 here. Then on the income statement, once again, there are no changes all the way down to net income. Shares outstanding goes down by 10 million here because of the same equation, 100 million divided by 10 equals 10 million. The cash flow statement, no changes to operational or investing activities. So we're using cash to repurchase these shares. So cash flow from financing goes down by 100. Cash goes down by 100. And then on the balance sheet, cash is down by 100. So total assets falls by 100. And then shareholders' equity also falls by 100. The technical treatment here is that treasury stock falls by 100, and so shareholders' equity falls by 100, so both sides are down by 100 and our balance sheet balances. This method of accounting for repurchasing shares is called the cost method for treasury stock, and basically all you do is you deduct from treasury stock the market value of the shares that you've repurchased. So in this case, we've repurchased 10 million shares at $10 a share. That's 100 million. That's what we deduct from treasury stock. There are other methods for doing this. I'm not going to get into them here because they're more complicated and because in interviews they're never going to come up. If you're wondering why we're not deducting anything from common stock here, the reason is because common stock really refers to situations where new shares come into existence. In this case, these shares still exist. It's just that they're in a different place. They're in the company's coffers now. They're in their treasury, so to speak. And so the shares still exist. It's just that their location has changed. And so that's why we're not modifying anything in the common stock number here. So that's a quick overview of what it actually means to issue shares, to repurchase shares, how it's reflected in accounting terms, why a company might want to actually do one of these, repurchase shares or issue new shares, and then how you go through the most common accounting questions, how you go through them at a high level, and then in more detail what actually happens within the shareholders' equity line item to the individual items in there when you issue new shares and then when you repurchase shares outstanding.